Hey, it's Joel Olson coming at you with another variable rate update. We are in the week of July the 18th. We are just about one full week since the Bank of Canada made their meaningful change, surprising everyone with a point above the market. So I want to make you aware of a couple of things that have happened since then. First of all, a meaningful drop on fixed rates, like a meaningful one. A lot of fixed rates dropped by 0.5% Friday and Monday this week. So now, I'm not recommending this. I don't think this is the best plan. I'm not doing this. But if you thought you're waiting for the one point where a fixed rate had a bit of relief to lock in, I suppose an argument could be made that now is one of those times. So, big drop in the fixed rates. Was that expected? Yeah, it was expected. Bond yields moved the way they did, and we thought that would happen. Secondly, we saw on the U.S. side of things, the Fed really backing off the idea that they would go full percent and still sticking around the 75 basis point increase. So a few things to be kind of aware of there, and a few things to, just kind of let you know on that front. I made another video on our channel, just how you would, if you're feeling the pinch, you're getting letters this week about the payment change, how could you offset that with your house? So I did a separate video on how to offset that. Look, this is what it comes down to this point. I do not believe there is a logical path forward for them to raise rates. Yeah, okay, all your smart friends are telling you they raise rates to curb inflation, and inflation's still off the charts, so they're going to continue raising rates. I do not believe that's the correct assessment. And the reason I don't believe that is because I think rates moving is doing nothing to curb inflation. The inflation they're measuring anyway. The housing market is already been depressed and reined in, which was forming a very significant part of GDP. We already this week see some gas prices dropping, and we definitely have a different consumer confidence. So I'm not convinced that inflation will be tamed by raising rates. So I do not see a path to raising rates further from that perspective. I think the most likely and the most logical path is this is going to taper off, and it could taper off quickly, especially if recessionary activity happens quickly. And so what's going to trigger that? Well, look, we have a pretty significant amount of savings that have been inside the average Canadian's bank account as a result of not having anything to spend it on during COVID. And so as that money gets put into the market based on extra costs and those types of things, that like extra interest costs or extra costs of anything, that is going to start to trigger some more recessionary activity. We could see people that were what I see were house hoarding. I have a couple houses. I'm not really renting it out due to Residential Tenancy Act rules. Now the increased mortgage costs, now I'm renting it out to offset those costs. So putting, making that spread a little bit better. So I think there's a lot of things that can happen, and I think it could happen very fast. And so that's the most logical thing at this point, that rates have a path headed down, and that the Bank of Canada has completely bungled it all up, moved it up, and we'll have to move it back down, albeit at a more gradual pace. If that doesn't happen, they continue to move rates up, ignoring, consumer sentiment. I think that it just shows they're completely unhinged from reality. And I know people disagree with that, but I think it just means we have to have other strategies for the time being in the meantime. I'm asked a lot, if we look at especially 2020 and 2021, would we have still recommended a variable mortgage knowing there were some fixed rates that were meaningfully lower? The first thing I would say that is a very strong yes. I know I said that before, but I want to give you two reasons, well, actually three reasons around that. Number one, and this matters, it is not true at this point that you would have been better on a fixed or a variable rate over a variable rate from the purely mathematical equation of interest. It's not true. It's just not possible because there hasn't been rates high enough for long enough. Yeah, okay, you can make the argument that rates are staying high for a little bit of time, and so that's going to offset it, sure. But at this point, you have not done better on a fixed rate than doing a variable. It's not possible. That's simple math. And so I need to make that really, really clear. Secondly, if a recession is inevitably happening, which I think that's a foregone conclusion, the last thing I need is that I think is a good idea is clients lacking the flexibility. Listen, if I put 5% down in a house, I had a CMHC fee of 4.1, I really ended up netting 1% down on that house. 1% down. And so if house values, let's just say they don't decline, but let's just say they stay static. Okay, so I'm going to sell my house. And if I need to sell my house because I get divorced or I change jobs, I'm going to be underwater. Add those realtor fees up, I'm easily talking about $30,000, $40,000 I got to come up with to sell my house. Do I wish I had you in a fixed or a variable? I'll tell you right now, I wish I had you in a variable then, because that means you're not as likely to be underwater on that house. And this is a very misunderstood thing: is that just because rates are going up, it doesn't mean your penalty on a fixed rate will be 3 months interest. It's based on what's called the comparison rate. So if I have 2 years left, it's based on a 2-year rate. You know what rate's going up a lot right now? The 2-year fixed rate, not the 5-year fixed rate, but the 2-year fixed rates went up for all lenders. So. And the third thing is that, and I really put a lot of weight in this, is that I have more than one mortgage. They're all in variables. I haven't even thought about locking them in. And that tells me that, like, the reason I don't lock them in is because I've been in this business a long time, and I know that, like, the statistics tell me that 90% of the time a variable does better than a fixed rate since World War II. And so I know this to be true, and because of this, I know that these things will level out. I know that, like, for every client that is upset today that really felt like they could have a fixed rate, I know that, 1 to 2 years down the road, they will regret being in a fixed rate. I know that because, there was a point when we sold a lot of 10-year fixed rates. We thought it was a really great idea. They're 3.69. Wow, that was incredible, and found almost every single client paid them out as a result. So anyway, that is your variable rate update today. We're going to put out a bunch of other videos. The one thing I really want to leave you with today is that I think it's really important to increase your financial intelligence these days. Understand the stuff, some economic things, rates and terms and those kind of things, like really have that dialed in. We're going to be publishing in the next 7 days. We're going to be publishing a list of the 10 people that I listen to and watch. I don't agree with everything they say, but I think they're the smartest folks, and I think they're people that I like to chew on what they say. If we can help with anything, please do schedule a meeting with us. Share this video with your friends. We'd love to help them out as well. And subscribe to our channel. It really helps out with that. Thanks so much. Have a great day.